All norms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move.
You're watching Silver News Daily. Subscribe for more.
The silver market is a ticking time bomb, and most investors are completely blind to it. For decades, this market has been rigged. Paper contracts, synthetic supply, and shadowy tactics have kept prices in a chokehold while the fundamentals have been screaming higher. But that illusion is cracking. Right now, we're standing at the edge of the most explosive silver move in 50 years, and the triggers are already being pulled. We're not talking about a gentle rally to $60. We're talking about a total price detonation, with targets being thrown around from 200 to even 500 an ounce. Why? Because the entire structure that's been used to suppress this metal is finally breaking under its own weight. Technical analyst Michael Oliver just revealed two obscure spread charts that signal something we haven't seen in half a century. He's not talking about moving averages or support lines. He's talking about a total paradigm shift. According to him, traditional silver analysis is about to be rendered completely useless. A total falsehood, as he puts it. And the moment this breaks open, latecomers won't just miss out. They'll be left in the dust, watching from the sidelines as silver escapes its chains in real time. This isn't hype. This is what happens when supply collapses, demand explodes, and financial markets buckle all at once. The conditions are aligning right now, and once they snap into place, there will be no rewind button. If you think $50 was the top, you're about to get a front row seat to the most violent price revaluation in the precious metals market. So what exactly is the mechanism that's held silver down for so long? And what happens when it finally fails? Stick with me. This story is just getting started.
No, the pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down, and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I could see a clear ceiling that's been built, such that I'll give you a number. It's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm going to break out of that base. So all you do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, oh, I got to go to $40 or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when...
For years, the silver market has operated like a rigged casino, where the house always wins and retail investors never even see the dice being loaded. At the heart of this manipulation lies the paper silver market, especially on the COMEX, where hundreds of millions of ounces are traded on contracts that are never backed by actual physical metal. Think about that. While physical demand for silver has surged globally, institutions have been selling phantom ounces into the market, artificially flooding supply and keeping the price suppressed. And now, the system they've relied on to keep that illusion intact is beginning to unravel. COMEX registered inventories have collapsed to just 28 to 32 million ounces, the lowest level in decades. That's barely enough to meet a few months of industrial demand, let alone satisfy a wave of panic buying. On paper, there might be 400 million ounces available, but peel back the layers, and you'll find that most of that eligible silver is locked away in ETFs or owned by parties with no intention of selling. It's a hollow promise, a shell game that's kept the price of silver in check while real, physical stockpiles vanish from underneath it. Every time silver prices try to surge, a flood of new contracts appears, pushing the price back down. But here's the catch. That game only works as long as no one calls their bluff. And today, more investors, stackers, and even institutions are demanding physical delivery instead of settling in cash. That's why COMEX is being drained, and why the illusion is cracking. The suppressed pricing mechanism is losing control, and the next time silver makes a serious move higher, the manipulators may not be able to cap it. We're not talking about a conspiracy theory anymore. This is structural. And when you understand how the price has been held down for so long, you'll start to see just how massive the breakout will be when the lid finally blows off. But what's the signal that tells us the moment of collapse is near? That comes from a chart the mainstream never talks about, one that's flashing red right now.
It broke out versus gold, the spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued and investors just say, phooey with that market. It's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say, look at the silver gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
While most analysts are glued to daily price charts and moving averages, Michael Oliver is watching something far more revealing. Spread charts that track long-term momentum shifts, hidden beneath the surface noise. And what he's seeing now is almost identical to the setup before silver's most violent surges in 1980 and 2011. His focus? The silver-to-gold ratio, not just as a price comparison, but as a percentage-based trigger that exposes when silver is about to break free from gold's shadow and launch into its own supercycle. And that trigger point? We're almost there. Right now, the silver-gold ratio sits around 79.8, with silver at $47 and gold near $3,770. Oliver tracks this ratio as a percentage, currently around 1.253%. But his breakout signal is locked in the 1.30 to 1.32% zone, which would take the ratio down to about 75 to 77. Once silver crosses that line relative to gold, history shows the price doesn't just go up, it goes vertical. We've seen it before. In 2010, once the ratio broke below resistance, silver surged from $17 to nearly $50 in just 10 months. In 1979, a similar breakout led to the metal rocketing from $6 to over $45 in a matter of weeks. Both of those moves were triggered by this exact setup. And we're testing that line again. Right now, the ratio has been consolidating between 78 and 82 since June, gathering energy. It dropped as low as 74.5 during the May blow-off and spiked to 85 in October. But in November, it's rebounding hard, grinding right against the downtrend line. The resistance is being worn down, and when it gives, it won't just signal a new rally. It'll mark the beginning of the parabolic phase. That's the moment when the manipulation system breaks, when paper supply can't suppress price anymore, and when latecomers start piling in after the breakout is already underway. This is why Oliver says traditional technicals are now irrelevant. The market is shifting beneath the surface, and if you're not watching these deeper signals, you'll miss the move entirely. But if the charts are confirming the setup, what about the physical side? What's happening on the ground that's making this potential breakout even more explosive?
When that spread breaks out, it says something's beginning. Okay? It's not saying, oh, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously, during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore, the spread was negative. Gold was underperforming. But since I actually go back 11 years now, about from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. This now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm an old trend. It's saying I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it. We know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 4 or 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, et cetera, far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an eightfold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning. Watch the spreads.
While the charts might be flashing breakout signals, it's the physical side of the silver market that's truly setting the stage for something historic. The supply crisis brewing right now is deeper than most investors realize. And unlike other commodities, silver isn't something you can just ramp up production on. That's because around 75% of all silver mined globally doesn't come from dedicated silver mines. It's a byproduct, scraped out of copper, lead, zinc, and gold operations. That means even if silver hits $100 or more, miners can't just flip a switch and flood the market. They're not mining silver. They're mining something else and getting silver on the side. This is why silver supply is incredibly inelastic. No matter how high the price goes, production barely budges. In fact, we're already seeing global mine supply either flat or declining. In 2025, production is estimated between 820 and 840 million ounces, barely moved from last year's 831 million. And the future doesn't look any brighter. There are no major primary silver projects set to come online before the end of the decade. Even the big base metal mines that supply most of the world's silver, like Red Dog and Rampura Agucha, are aging fast new copper projects that could bring more silver. Most of them aren't due until the 2030s. To make matters worse, recycling isn't picking up the slack. Despite prices nearing all-time highs earlier this year, silver recycling is still at multi-decade lows. Why? Because prices haven't risen enough to incentivize large-scale scrap recovery. Old electronics, jewelry, and silverware aren't hitting the market at the pace needed to cover the growing gap. And that gap is huge. In 2025, the silver supply deficit is expected to hit 145 to 182 million ounces, the second largest shortfall ever recorded. What this means is simple. There is no quick fix. No flood of new silver coming to meet demand. No hidden stockpiles waiting to stabilize the market. The structural supply constraints are baked in, and they're colliding head-on with one of the most ferocious demand surges in the metal's history. And that demand? It's not coming from investors. It's coming from the industries of the future.
NASDAQ that would say, uh-oh, you're probably headed down. Now, not disastrously. We think what's been going on in the U.S. stock market since late last year, in fact, is a topping process. We made our high in January, February for the NASDAQ 100, S&P. We had the headline sell-off, which you don't like. If you're a bear, you don't need a headline. You'll get them later. You know, this bank fails, this company fails. You don't want to hear it at the beginning. So we heard this tariff stuff suddenly became the be-all and end-all of the world. Now it looks like the Supreme Court might sort of push some of that aside, in which case that's not even an issue anymore. Well, let's get it out of the way, because frankly, the reason the stock market would top is not because of some headline, which Trump, of course, tried to solve by saying, oh, I'll give a 90-day delay, and so we had a rally off the April low. But making the new high, for example, in the S&P above the January high, we got another 10% or so above the January high. And now we're slipping off some. We think it's all part of the topping process. The same thing happened in 2000 and in 2007 when the S&P was topping. It made a high, looked negative enough for us to say, get out of this category, dropped, but then came back and made a new high, which was a teaser. Whereas if you succumb to the new high and thought, oh my, the game's on again. No, you were wrong. It was a trap. And in fact, the one in 2007 that made the new high was in October 2007, a few weeks after the Fed, surprise rate cut. So if you bought the Fed rate cut, thinking, oh boy, game's on, you bought the top. Okay. Anyway, I think we're in the same situation now. We're getting a laborious top that spans a year or so of up-down action that's confusing, but it's topping according to our momentum work. When that occurs, money will go somewhere else. And the normal two places it's gone in the 2000, 2002, 2007, and 9 bear market and the stock market were T-bonds and gold, especially gold. Well, T-bonds are dogs. They're not behaving well. They get little rallies, little sell-offs, get a little rally today because stock market's weak, but they're stuck in this range for 3 years. They can't get off the mat. Something's wrong there. We all know what it is, okay? So it leaves you, if the stock market starts to break, where's the money going to go? The one place that's smiling, monetary metals, okay?
Silver isn't just money anymore. It's infrastructure. It's the bloodstream of the green revolution, the digital age, and the AI-powered future that's now unfolding faster than anyone expected. More than half of all silver demand now comes from industrial uses, and unlike investor-driven demand, these industries don't wait for price dips. They need silver, and they need it now, regardless of cost. That's what makes the current demand spike so dangerous for the already broken supply side of the equation. Let's start with solar. In 2025 alone, the solar industry is expected to consume between 280 and 320 million ounces of silver. That's nearly 30% of total global mine supply, and it's still growing at 25 to 30% year over year. And this isn't speculative. It's already happening. India alone added 85 to 90 million ounces worth of demand just this year, joining China in dominating global solar installations. And while manufacturers have managed to cut the amount of silver used per panel over the years, the total demand is still exploding because the number of gigawatts being installed is going parabolic. There's simply no substitute for silver's conductivity in high-efficiency cells. Without it, the solar boom stalls. But it doesn't stop there. Electric vehicles are chewing through silver at a blistering pace. Every EV, every charging station, every high-efficiency electrical system needs silver. By 2030, EV production is expected to triple, and the silver intensity per vehicle is rising as automakers push for better efficiency and more powerful electronics. Then there's the wild card few investors are even considering. AI. Massive data centers, AI supercomputers, and power-intensive infrastructure all depend on silver. Bus bars, high-voltage switches, and silver-plated contacts are critical to keeping these systems running. And this year, for the first time, AI-related infrastructure is already pulling tens of millions of ounces into industrial use. These aren't fads. These are irreversible technological trends backed by trillions in global investment. And they're hoovering up physical silver at a rate the mining sector cannot meet. The deficit isn't just a chart. It's physical metal disappearing off the market and never coming back. And while the world is sleepwalking into a scarcity crisis, the financial system is standing on a cliff of its own.
Our action sometimes of silver and gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay. They're making a mistake. Okay. But you can see it in the hourly ticks where the short-term traders say, oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded. Not hour by hour, but month by month, okay? So S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up. Okay? So people need to rethink that assumption because it will trap them into missing something.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, Real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
The stock market is on thin ice, and when it cracks, it could be the very event that ignites silver's long-suppressed explosion. All it takes is a spark. Right now, we're watching overvalued equities sway under the pressure of a global slowdown, rising debt defaults, geopolitical tensions, and a monetary system that's lost credibility. The Fed may talk tough, but beneath the surface, central banks are trapped. They can't raise rates without breaking the system, and they can't print without reigniting inflation. That's why investors are quietly shifting from paper assets to hard money, and when the dam finally bursts, silver will be the ultimate beneficiary. We've seen this movie before. In 2008, stocks collapsed and silver dropped briefly, only to rocket from $9 to nearly $50 over the next 2 years. In 1979, runaway inflation and a weakening dollar led to a panic out of financial assets, triggering silver's legendary move past $40 in just months. In both cases, silver lagged at first, then erupted. But this time, the setup is far more severe. Silver isn't just undervalued, it's structurally mispriced. It's been artificially held down while every other asset class, from stocks to real estate to crypto, ballooned into speculative bubbles. Now, those bubbles are popping, and silver stands as one of the last real stores of value left standing. And here's the twist. Gold is already moving. At nearly $3,800 an ounce, it's signaling that the smart money is preparing for financial fallout. But silver? It's still hovering well below its all-time nominal high of $50, let alone its inflation-adjusted highs. That discrepancy won't last. When the next wave of panic selling hits the markets, silver won't act like a precious metal. It will behave like a leveraged bet on financial collapse. A small move in investor capital fleeing the stock market is all it takes to flood into the tiny silver market and overwhelm supply. This is the moment when retail wakes up, when hedge funds stop laughing at silver bugs and start placing bets themselves, and when mainstream media finally begins to ask why silver, the most ignored asset in the financial system, is suddenly going vertical. But by then, the next phase will already be underway: the stampede.
We showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987, when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up. There was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising 3/4 moving average. And therefore the oscillator showed a repeated drop to the zero line, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone. This is the 4th time that Bitcoin since 2023 has dropped down to its 3/4 average. That number this quarter is 101,390. We've been trading below and above that for the last few days, so we've come down to that structure again for the 4th time. We don't think it'll hold this time. The question is, do you wait for a monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like in 87 for the S&P? That's our assumption. Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which by the way is highly correlated to the month-by-month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. In other words, it could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100 is practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on NASDAQ 100 because the same speculative inhale-exhale fever is going on there. And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly, they become weak components of the S&P and the NASDAQ. Watch it. Watch Bitcoin. It's very important.
The silver market isn't just underground. It's practically invisible to most investors. And that's exactly why its breakout will be so violent. When capital shifts, it always moves where it's treated best. And silver, right now, is one of the few remaining assets with asymmetric upside and almost zero crowding. The average portfolio has little to no silver exposure. Most institutions haven't touched it in years. Even retail stackers, burned by years of price suppression, have backed off. But that's about to change, because when silver starts to run, it doesn't just attract interest. It triggers a stampede. Momentum is everything in markets. When silver crosses $50 again, a level that's acted like a psychological ceiling for over a decade, it won't be seen as just a breakout. It will be seen as confirmation that something big is happening. That's when retail buyers flood in. That's when silver goes viral. And that's when institutions, desperate for real yield and a hedge against monetary chaos, begin to take notice. We're talking pension funds, sovereign wealth funds, even central banks. They won't tiptoe in. They'll slam the door open, and in a market as small as silver, that's all it takes to light the fuse. Remember, this isn't gold. The entire above-ground investment-grade silver stock is a fraction of gold's. The COMEX has around 28 to 32 million ounces of registered silver available for delivery. That's barely a rounding error for one large institutional buyer. And once it becomes clear that physical delivery is tightening, when premiums start to spike and delivery delays stretch out, FOMO will turn to panic. Dealers will go out of stock. ETFs will scramble to source physical, and the paper markets will start to convulse under the pressure. This is how short squeezes start. Not from slow, steady accumulation, but from sudden, overwhelming demand in a market that cannot meet it. And when that panic hits, the price doesn't just rise, it gaps higher, day after day, leaving those who hesitated with no chance to catch up. The longer this suppression continues, the more energy builds beneath the surface. And when it releases, it won't be a climb. It'll be a launch. But just how high can silver really go? That answer may sound crazy until you run the numbers.
Terms of technical analysis like RSI and so forth will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, go back to the 1970s, and you'll see that they were in a range It's 1970s, 80s, 90s into mid 2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production, Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row. Supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver's just marginal to them. Therefore, if silver...
A silver price of $200 to $500 sounds outrageous until you actually do the math. Most people hear those numbers and scoff, thinking they're pure hype, but history, market mechanics, and simple supply-demand economics tell a different story. In every major bull cycle, silver has shown one consistent trait. When it breaks out, it doesn't just double, it goes vertical, and often overcorrects far beyond what fundamentals alone would suggest. That's how silver went from $6 to nearly $50 in 1980. That's how it surged from $9 to $49 in 2011. And that's the setup we're staring at again. But this time, the backdrop is even more extreme. Let's talk about the gold to silver ratio. Historically, when the ratio narrows, when silver begins to outperform gold, that's when the biggest gains occur. In 1980, the ratio fell to 15. In 2011, it dropped to 31. Today, it's hovering around 80. If it returns to 30 while gold remains near $3,800, silver would need to be priced at $126 just to match that historical relationship. If the ratio overshoots, as it has in every past cycle, we're suddenly looking at $150, $200, even higher. And that's before we even factor in structural deficits, industrial demand, and monetary panic. Then there's inflation-adjusted pricing. The 1980 high of $50, adjusted for real inflation using honest metrics, is well north of $150 today. In a financial reset scenario, where currencies are repriced and tangible assets surge, silver hitting 500 isn't just possible. It's logical. We've already seen what gold has done in response to central bank hoarding, collapsing trust in fiat, and the breakdown of sovereign debt markets. But silver? It's still playing catch-up, and the moment it closes that gap, the speed will be shocking. And let's not forget, silver is the smallest major market in the world. A mere trickle of capital from stocks, bonds, or crypto can move it like a tsunami. The total size of the global silver market is a rounding error compared to equities. It doesn't take trillions to send it soaring, just billions. And when the financial world starts looking for shelter, silver becomes the high beta bet on a collapsing system. Every suppressed dollar is energy waiting to be released. Every capped rally is fuel. And when the breakout finally hits full force, there will be nothing standing in its way. But there's one final piece to this puzzle, the part that will completely change the game forever.
Silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also, if you go back and look at 1980 high at 50 or 2011 at 50, and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, you know. Well, if you factored that in, silver would probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. And the problem with getting over 50 recently is we surged from a low under 30 in April. Okay, started to come back up in May, and in June got back up to 34 plus, had two prior highs at 35, May last year, March of this year. So in June of this year, came back up to 34, headed toward those highs, and momentum said you're going to break out and you're going to explode. It's significantly different than what you've been doing instead of incremental. Well, sure enough, you went from what, $35 to 53 in what, a handful of months? I think it deserves a correction. Plus, when you took out the 50 high, what happened? Every idiot investor out there who thought the two highs at 50 were meaningful. Again, nominally they are, but in real terms they're meaningless, real dollar terms. They got sucked in to buy it finally. And so you had latecomers come in at 52, 53, and they bagged them. Good. Should have been bagged. They should have been buying silver in the 30s or the 40s or the 20s even. And when they bought high, it created a vulnerable group of people. And so that's a logical place to have finally a correction that you could call a correction. You break that spread out, silver versus gold, and add to the gold stock market spread breakouts, which have already occurred, just waiting on the S&P now for that factor, the game's just beginning. And that's when you see a total change in what you expect and in tonal nature of the markets. Something more like what occurred 79 to 80. And by the way, when we get there to those levels, oh, sure, you get a sharp correction maybe, but you're in a new reality. You're not going 150, 200 and come back to 50, okay? You're going to live in a new reality up there. You know, maybe it's between 150 and 250, I don't know, but it's the main focus right now is that surge, because it should be very dynamic and a place to be you've probably not been in your entire investment lifetime. So game is on, but we're watching those two metrics, gold S&P, silver gold.
For decades, silver has been shackled by a system designed to keep it under control. Synthetic contracts, manipulated benchmarks, false narratives about oversupply. But every manipulation system has a shelf life, and silver's is now reaching its breaking point. What we're seeing today is not just technical resistance being tested, it's the structural framework of price suppression beginning to collapse from within. And when it does, the entire paper-based pricing mechanism could unravel, triggering a revaluation event unlike anything in modern financial history. Look at the signals. COMEX inventories are at multi-decade lows. Registered silver, the kind actually available for delivery, is barely enough to handle a fraction of open interest. Meanwhile, more investors are refusing cash settlement and demanding physical delivery. This isn't just a kink in the system, it's a slow-motion breakdown. Add to that the massive global deficit that's been growing for 5 straight years, approaching a cumulative shortfall of nearly 850 million ounces. And the math becomes impossible to ignore. The manipulators are being cornered. At the heart of this collapse is trust, or rather, the loss of it. The paper silver market only works if participants believe the contracts they're trading actually represent something real. But what happens when that illusion is shattered? When institutions start asking for metal and it isn't there? When ETFs are forced to halt redemptions or revalue their assets? That's when the dam breaks. That's when the decades-long price cap becomes a slingshot. And here's the irony. The very tools that were used to keep silver prices suppressed are now becoming the accelerants of its explosion. As short positions unwind, as hedges get squeezed, as liquidity dries up, the manipulators will be forced to cover into a rising market with no available supply. That's how parabolic moves happen, not from buying strength, but from a desperate scramble to escape the collapse of a lie. This isn't just about silver anymore, it's about credibility. And when the world loses faith in the institutions that have suppressed real value for generations, silver won't just reclaim $50, it will rewrite the financial rules entirely. But before we wrap up, there's one final message every investor needs to hear. Because what's coming next won't be forgiving to those who hesitate.
We look at all four major asset categories in our all-asset subscription, bond markets, foreign exchange, commodities broadly, but especially silver and gold, and the stock markets, not just ours, but elsewhere as well. Because you got to look at these things because they're all banging into each other. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market, and especially the miners are a tiny little market. You move much money from the stock, but look what's happened to GDX recently. Would we go from 40, 50 up to 80, $80? Bam, like that. That's a new reality. And therefore, the action of these other categories is very important to further fuel them.
The illusion is ending. The forces that have kept silver subdued for decades are crumbling. And what comes next is a market event that will shock everyone still clinging to old models. $50 silver was just the opening act. What we're heading into now is a full-blown revaluation, driven by physical shortages, explosive demand, and a global loss of faith in fiat money and financial institutions. Silver's moment has finally arrived, and when it breaks out, it won't be gradual. It will be sudden, violent, and irreversible. Those who've been watching from the sidelines, waiting for confirmation, they'll miss it. Those who've been told silver is a relic, too volatile, too slow, they'll be blindsided. And those who understand what's really happening under the surface, they'll be holding the most explosive asset of the decade. You don't get many second chances in financial markets, but right now, one is sitting in plain sight. So if you've made it this far, you already know what's coming. Silver's breakout isn't a matter of if, it's a matter of when. The signals are in place, the manipulation is failing, and the energy is building for the kind of move that doesn't come around often. Stay ahead of it, stay informed, and if you found this discussion valuable, make sure to subscribe so you don't miss what's coming next. And remember, this is not financial advice. Always speak to a qualified professional before making any investment decisions.